Okay, good afternoon, everyone. Today is the 18th of July, 2021. I will be discussing on how do we account for provisions and how do we make relevant disclosures regarding contingencies, either contingent asset, contingent liability, and we'll discuss all of this with respect to the requirement of IAS 37. Okay. Now, starting with our discussion, we're going to look at the objective of this standard. And the critical objective of the standard is such that it ensures that appropriate recognition criteria and measurement bases are applied to provisions. And likewise, relevant disclosures are made with respect to contingent assets and contingent liabilities, and where necessary, that sufficient information on both provision and contingencies are disclosed in the notes to the financial statement, which is an enabler for the users of financial report to gain better understanding about the nature of provision and contingencies, about the timing and amount that may be involved. That is a primary objective of the standard. Furthermore, we'll get to discuss more that the standard has a scope, and the scope of the standard is such that it applies to all entities, provided they are making an accounting for provisions and contingencies. But there are exceptions to this rule. The only time this standard, which is IAS 37, will not apply in all respects will be where provisions or contingencies result from executive contracts. Okay, except where such an executive contract is onerous. And we're going to discuss that as we move on. What constitutes executive contract and when can a contract become onerous? Okay, and secondly, it doesn't apply to specific provision requirement that may have been addressed by any other standard. Okay, which means without these exceptions, the standard IAS 37 applies to all forms of recognition and measurement regarding provisions and contingencies. Okay, now I want us to move ahead by looking at one or two critical things with respect to our discussion there. Okay, we will be looking at let me share my notes. We'll be discussing on IAS 37, provisions and contingencies, which will include assets and liabilities. I think I have to structure my pen in a better fashion. Okay, let me try and clean it up and write it. It's not clear enough. Provisions and contingencies. Contingencies with respect to assets and liabilities. As I've said earlier, the objective is to give us guidance towards the recognition and measurement of provisions and contingencies and relevant information that have to be disclosed in the financial statements. Okay. Now that is that. Now, let's look at the scope. We make mention of one or two things about the scope. Okay. What is the scope of the standard? Now, as I've said earlier, the standard governs all forms of provisions and contingencies that needed to be accounted for or disclosed in the financial statement. But again, the exclusion or exceptions to that rule border on two things. One, if the standards peradventure has more or less been addressed or provision has been addressed by any other standard, in that situation, you cannot make use of IAS 37. Or in a situation where there is an executive contract, okay, and the executive contract is deemed not to be onerous. Otherwise, if it is onerous, in such instance, the standard will apply. And as I've said earlier, when can we say an executive contract is onerous? We're going to see that as we move on. Now, before we move on, I want us to give one or two expectations from what we want to discuss so that we can commence in full.
Okay, good afternoon, everyone. Basically, I think for me, this standard IAS 37, professional contingency, is very important. It's something that one comes across on a daily basis. And I see this today's session as an opportunity, though one has basic understanding of it, but I think it will be an opportunity for me to learn it further and have a thorough and be well grounded in it and apply it practically in my career. Because I know, for instance, there was a case in our organization where all of a sudden a bill was brought to us that we were owing a particular government agency about 10 billion or thereabout, government agency that we were not aware of. It was not carried in our books. And the current management, they were not really very, very concerned with it. So, and we're actually at the concluding part of our financial statement for the year. I'm talking about this thing happened this year. And I was kind of looking at how do we treat this kind of situation? This bill, 13 billion, 10 billion. I don't know if this government agency, if we don't resolve this thing or reconcile this thing, one way or it has to be disclosed, or is it to be disclosed, or do we have to put it there? What information do we need? So it was really heated debate in our organization because the amount is very huge, and we're looking at the impact in our financial statement. Management is actually in the return is actually in negative already. So we are looking at. I started going through this standard to see how best to treat it and what to tell my superiors and the way to treat it. So I think situations like that always occur in businesses, whether we have a lot of court cases. And so I think today's session will definitely, for me, be an eye-opener and expose me to more aspects of this provisional contingency in my day-to-day work. Thank you.
Thank you very much. Okay. Now, those are the things we need to get to know. Okay, I want you to read where I'm pointing to. Okay, can you read this objective and this preface on provision again so that we can move on?
Okay. Objective. IAS 37, provisions, contingent liabilities, and contingent assets. aims to ensure that appropriate recognition criteria and measurement bases are applied to provisions, contingent liabilities, and contingent assets, and that sufficient information is disclosed in the notes to the financial statements to enable users to understand their nature, timing, and amount. Provisions. Before IAS 37, there was no accounting standard dealing with provisions. Companies wanted to show their results in the most favorable light used to make large one-off provisions in years where a high level of underlying profit was generated. These provisions, often known as big bat provisions, were then available to shield expenditure in future years when perhaps the underlying profit were not as good. Okay, I think I can see. In other words, provisions was used for profit smoothing, profits. I can't even sit down very well. I think I see profit smoothing is misleading.
Okay,
That's the last part.
Yeah, what is being said is that over time, people have used provision as a way of earnings management, like manipulating their books to show better performance or desired performance. And we are saying that no, provision should never be used as a way of smoothing profit because it will be grossly misleading for the users of financial reports. And that is what we are saying in that regard. Okay, now one thing we then need to ask ourselves is provision, what is it in its real sense? Now, if we go back to our discussion, during the period we had deliberation on conceptual framework, you can revert to the video. You'll find out that we try to distinguish between three forms of liabilities. Okay, let me put it up here.
Yes, I remember we talked about provisions, accruals, and payables.
Yes. Liability takes three dimensions. Payable, accrual, which is through accrued expenses, and provision. Now, what is common between three of them is that they are all liabilities. But what is the difference? Payable means the amount is due, and invoice has been raised or issued to you as an entity. That's why it is payable. Accrual means amount not necessarily due and invoice yet to be issued. Can you give me an example of payable where amount is due and invoice have been raised? You purchase goods from someone, the goods have been delivered to you, and invoice has been issued and delivered to you. At that point in time, such a liability becomes payable, even though it might be payable at a later date, but it becomes payable. It is due, awaiting passage of time. But for accrual, it's usually synonymous to utilities or services. For example, let's assume you use postpaid for water bill, electricity bill, and etc. But you know unit of consumption. You know the likely rate. At the end of the month, it might take another 1 month or weeks before bill are issued. But for completeness, your account have to be closed. Therefore, what do? You determine what is your consumption and what was the agreed rate, if any, and use it to estimate what is likely going to be the amount of invoice that will be issued to you. And in that case, what do? You accrue for such an expense, and that is an accrual. It only becomes payable whenever invoice has been issued, even though consumption has taken place. Now, when you look at payable, payable is 100% certain. Certainty is clear. Accrued expenses is equally certain to some degree, subject to minor differences between what you might have accrued for and what was actual. But the degree of certainty is closer to payable. But what is provision? In all respect, provision is widely uncertain. Why? Because the nature of provision is that it's uncertain with respect to either amount that will be due or when it will be due, timing. And therefore, that presupposes that provision first is a liability, but second is a liability that is embellished in uncertainty with respect to amounts or timing. And that is that. Therefore, we can express ourselves in trying to understand further what provision is all about. And that's why we first of all establish from our discussion that provision is a liability of uncertain timing or amount. And two, we need to also understand what a liability is. From the conceptual framework, we are made to understand that a liability is a present obligation of an entity that arose from past events, of which the settlement is expected to result in an outflow embodying economic benefits. And liability by conceptual framework is a present obligation that always transfer economic resources out of the entity. And therefore, we need to understand this. The uncertainty attributed to provision is what makes us to have a standard in order to standardize the process such that it is not used inappropriately for earnings management or what we call profit loss smoothing, or because it will automatically be misleading. And anything misleading would taint the primary objective of our financial reporting, and which expect us to provide appropriate financial information that will aid sound decision making by the users of financial statements. Now, any question on that before we proceed in our discussion? Any discussion? Otherwise, we proceed to recognition. When do you recognize provision? Remember, everything about financial reporting border on RMD. The R stands for recognition, the M stands for measurement, and the D stands for disclosure, which embedded in it contains presentation. Now, the question is this: when should provision be recognized? Now, the requirement of IAS 7 clearly provide guidance that 3 conditions must be met for provision to be recognized. The first condition is that there should be present obligation. The second condition is that the present obligation must be highly probable that it will result in transfer of economic resources in order to settle such an obligation by the entity. And lastly, you can reliably estimate the amount of such an obligation. Otherwise, it might be practically difficult for us to recognize such a provision. We then speak to the fact that
please take those three again for recognition of provision.
Yeah, go ahead.
Recognition of provision.
Yeah, don't worry, I'm going to take it again. I've only tried to summarize it. Now, let's pick it one by one. The first condition is that one, there must be established present obligation. Now, one thing you need to know is that present obligation can either be a legal obligation. Legal obligation is contractual in nature, or because it is what can be admissible in a law court in case of litigation or disputes. And two, it could also be constructive obligation. What is the difference? A constructive obligation is not a legal obligation, but an obligation associated with a promise that had created a valid expectation. In the mind of the other party. We must take note of that. Now, let's give example of constructive obligation. A constructive obligation might be where an entity, by way of pattern of past practices, has continued to do something for the immediate community where it operates. So that the day you stop doing that, you create more or less environment that's no longer enabling, environment that can create civil unrest, environment that can become negative trajectory to your business sustainability. And in that case, such an obligation for accounting purpose are expected to be taken into cognizance, or because you failing to meet such obligation might erode further your economic benefits through various actions or inactions of this community or of those other parties, as the case may be. And therefore, such will be taken into consideration. But what is also key about it is that this present obligation must have arose from past events. The next one is that the probability of settlement is highly probable. Mathematically, it is more than 50%. For accounting purposes, the rule is that once something is more than 50% of likelihood of occurrence, we say it is probable. Okay, and upon being probable, Therefore, we can proceed to recognizing such a legal or constructive obligation. But it is further subject to the fact that we can reliably estimate in monetary terms the amount of the provision, even though we might resort to using expected value, that is statistical model, or using what we might call most likely estimates. All of this is to provide what we call a best estimation for the recognition of provision. Does that make sense now? Is it clear?
Yes.
Okay.
Yes, sir.
Okay. Now, the next thing we need to battle with is what constitutes probable transfer of resources, which I've explained, and what constitutes obligation. For you guys to have better understanding of what I've said earlier, I'm going to provide you with a short note that probably depicts all what I've said in order to sign it off as part of things that we have better understanding of. Okay. Therefore, I want us to look through these expressions and examples as it relates to the meaning of an obligation and when is it probable that there is a transfer of economic resources. Who will do that for us?
Let me read it. Let me read it.
Over to you.
Meaning, okay, meaning of obligation. It is fairly clear what a legal obligation is. However, you may not know what a constructive obligation is. Constructive obligation, an obligation that derives from an entity's actions where A, by an established pattern of past practice, published policies, or a sufficiently specific current statement, the entity has indicated to other parties that it will accept certain responsibilities. And secondly, as a result, the entity has created a valid expectation on the part of those other parties that it will discharge those responsibilities. For instance, an oil company may have an established practice of always making good any environmental damage caused by drilling, even though it is not legally obliged to do so. In this way, it has created a valid expectation that it will do this, and it will have to recognize the constructive obligation and make a corresponding provision each time it drills a new well. Probable transfer of resources. For the purpose of the standard, a transfer of resources embodying economic benefit is regarded as probable. If the event is more likely than not to occur. However, the standard makes it the probability should be based on considering the population as a whole rather than one single item. Example, transfer of resources. If a company has entered into a warranty obligation, then the probability of transfer of resources embodying economic benefits may well be extremely small in respect of one specific item. However, when considering the population as a whole, the probability of some transfer of resources is quite likely to be much higher. If there is a greater than 50% probability of some transfer of economic benefit, then a provision should be made for the expected amount.
Okay. Thank you very much. Now we understand that position, which corroborated all what I've said. Now the next thing for us is that if actually provision has occurred, okay, therefore, how do we measure the amount of such a provision? What will be the basis of our measurement? And that is what we need to understand at this point. Therefore, how should a provision be measured? Who can give us a guidance before we move on? How should a provision be measured? Who will give me a guidance? Now, I've said that the basis of making provision or estimating the value starts from management judgment, because the management judgment will more or less determine the basis of estimation. And there are two bases of estimation that might be used. The first one is the expected value methodology. The second one is recognition of most likely outcome in full. And what is that? Expected methodology is a statistical approach to estimating provision. And what does statistical approach take into cognizance? It takes into cognizance various scenarios or state of the world, such as most likely, most pessimistic, and most optimistic. Okay, or you use things like best scenario, worst scenario, and base case, or anything you call it. It's like looking at various scenarios in the course of estimation to say, okay, what under this condition, what will have been the estimate? What under the second condition, what will have been the estimate? What under the third condition, what will have been the estimate? And on that premise, we have these scenarios. And these scenarios is allotted probability weights, such that the sum of those scenarios, whether 2, 3, 4, or more, usually the scenarios in this state of nature is within 3 scenarios. But again, no matter the amount of scenarios, the sum of the probability must sum up to 1. Remember the principle of probability. Now, again, there is an amount that has been estimated for each scenario. And what do we need to do is to find a weighted average of those scenarios by multiplying the probability with the estimate at each state of the world or at each scenario. The sum of the weighted average value is what becomes our expected value. That is on one side. On the other side, the nature of what you want to provide for might be such that is a single item or is a single occurrence or outcome, such as legal cases, such as cases for damages, suit, and all sorts of things. And in that case, it is more likely that the most likely outcome will be what needs to be adopted rather than the expected value. And in summary or in conclusion, it is generalized that expected value is much more applicable to a situation where you have a large population of occurrence of items involved. For example, if you are making provision for warranty costs, when you have to distribute tens of thousands of items, therefore, it will be more likely to use expected value. But if you have a legal case involving a customer or involving a vendor or involving government, therefore, that will rather not be it rather consider the most likely outcome rather than using expected value because the population is single or very small. And on that premise, we are able to make estimation. Okay, now what I'm now saying is that The two methodologies, the two approaches to estimating provisions are: one, expected values. Expected values is simply the sum of the factor, which is the estimate, times the probability of that factor. And we are going to see that mathematically as we move on. What it means, invariably, is that looking at probability of occurrence in period 1, multiplied by the estimation for the first scenario, scenario 1, plus probability based on scenario 2, multiplied by estimate scenario 2, probability based on scenario 3, multiplied by estimates in scenario 3, will give us our expected value, which is EX. And the second one is full recognition of the most likely outcome. Can somebody volunteer to read out this? Measurement. Corroborate my explanation. Madam Grace?
Measurement. The amount recognized as a provision should be the best estimate of the expenditure required to settle the present obligation at the end of the reporting period, IAS 37, paragraph 26. The estimates will be determined by the judgment of the entity's management, supplemented by the experience of similar transactions. Allowance is made for uncertainty where the provision being measured involves a large population of items. The obligation is estimated by weighing all possible outcomes by their associated probabilities, that is, expected value. Where the provision involves a single item, such as the outcome of a legal case, provision is made in full for the most likely outcome. Except in extremely rare cases, an entity will be able to determine a range of possible outcomes and can therefore make an estimate of the obligation that is sufficiently reliable to use in recognizing a provision. IAS 37, paragraph 25. It is highly unlikely, therefore, that an entity will fail to meet the recognition criteria due to not being able to reliably estimate the amount of the obligation. That's all, sir.
Okay, thank you, ma'am. Now, if that is the case, let me now give us this exercise and let's estimate which of these two approaches is applicable for this question. Can somebody read out the question? And let's agree what will be the appropriate approach. Is it the expected value, or is it the full recognition of the most likely outcome?
Okay, let me read the question. Packer Co. sells goods with a standard warranty under which the company guarantees that its goods will perform as expected for a period of 6 months from the date of purchase. The company's past experience and future expectation indicate the following pattern of likely repairs. Percentage of goods sold, 75%, defect, none. Cost of repair of all items so far from this, okay, in Naira, okay. Sorry, there's a percentage of goods sold, there's a defect, there's a cost of repair from suffer from defect. So number one is 70% of goods sold, defect none, and cost of repair is nil. Then the other cost of goods sold 20%, defect minor, and cost of repair is 1 million. Then the next one is 5%, defect is major, and the cost of repair is about 4 million. So required, what is provision required?
Yeah.
I think this one should be expected value method.
Why is the expected value methodology?
Because it is, number one, it's not a one-off event. Two, it has there's a pattern, a historical pattern is established. So on that basis, and they have probabilities. Each range of defect has its own probability that is attached to it, and even a monetary figure. So I think that is why you use expected value.
Any other person? Any other person?
I agree with him. It's the expected values method that we use because of the past experience that we've had, and it's also probable that there are future indications of what the likely outcome will be. So we use expected value.
Okay. Now let's model it, since you all agree that is expected value. Now what do? We identify the state of nature, which are the scenarios. The scenarios of defect, we assume no defects, we assume minor defects, and we assume what? Major defects. Therefore, what percentage we've estimated based on our past experience, our data, that most of the time, 75% are not defective. 25% of the time, they are minor defects. And 5% of the time, they are major what? Defect, which shows that the sum must not be more than 1, which is 100%. But what I'm seeing here is, okay, this 20%. Therefore, it must not be more than 1, which is 100%. Next, if there's no defect, there's no cost to be incurred. But if there's defect, you are going to incur $1 million. $1 million for all of those items. And if there's major defect, you spend $4 million on all of those items. And the question then is, what is our expected value? If we go back to our formula, what's our expected value? Can you remember? This is our formula. Okay. Our expected value is at each state of the word, you multiply the probability with the estimation for each state, and you sum up on average to obtain your expected weighted, which is a weighted average. Therefore, doing that, what do? We multiply, which means we find the product of the probability and of the estimation. And once you average it, we sum it up. And our estimation is 400,000, which means we make provision of how much? That's the provision we make in this case. Does that make sense? Now, percentage give us our probability. Does that make sense, please? Any question about that? Is that clear?
Excuse me,
Yes,
sir.
sir.
Okay, my only question is that are we just using a percentage of the estimated cost of repairs, or is it that formula for the expected value? Because I am not tallying the formula to this.
Okay, what is the formula? Let me copy the formula. Okay, can you see the formula? What is PX? PX is the probability. What is X1? X1 is the estimate cost for each scenario. And PX times X1 is the expected value for that first scenario, second scenario, and third scenario. Does that make sense to you?
Thank you, sir. Clear.
Okay. I can copy that and paste it here. Does it make sense now? Does it make sense?
Yes.
Yeah.
Yes, sir.
Okay. Any other question? Now, what role does time value of money play in making provision? We discovered that the provision we discussed about just now, based on the expected value, there was no effect of time value of money. Who can tell me why? Why was there no effect of time value of money?
I don't in fact, because I think that it has to do with the current year, likely provision for cost of repair for the current year. But if it has to do with cost of repair for a future year, 2 years or 3 years from now, that will, the issue of time value of money may come in. That's what I think.
Now, what it means is this. Because when you make provision for warranty is always for a short period of time. The maximum warranty you can get from products such as phone and some other things like that, even cars, is less than 1 year. You are talking of 1 month, 3 months, 6 months. You can't get more than 1 year, which means it's current. Therefore, an effect of time value of money starts from 1 year upward. Are you getting it now? Which means everything will be due within a short cycle, which is within the operating cycle, and therefore time value of money is of no excess. But that will not be our story when it is now provision that relates to a longer item. Can you give me one example of provision you make for something that could take more than 2, 3, 4, 5, 10, 20 years? Remember, we discussed something in that light that we say when we get to IAS 37, we are going to make further explanation. Can you recall?
Or mention.
I think
Mention is outside the scope of this because it has been addressed by IAS 19 separately. What do you think, Mr. Enaro?
yes, I think that you can have a situation where you make a provision for instance, you are building something, and you agree that this thing will be, for instance, you dismantling cost and we were talking about something like dismantling cost and everything. So you make provision for it, even though you're going to use it for something like that. Yeah, for a couple of years.
More than 100% right. Under PPE, we discussed it extensively under IAS 16. That part of the cost of an asset are provision relating to restoration, decommissioning, dismantling, and etc., or abandonment. And this is a clear example of provision that will require effect of time value of money. Which then means that we now have to discount it once it is 1 year and above. Does that make sense?
Yes.
Okay, that's why here we said where the effect of time value of money is material, and it is material from period of year 1 upward, the amount of provision should be the present value of the expenditure required to settle the obligation. And an appropriate discount rate should be used. And what is the appropriate discount rate? The discount rate that reflects the current measurement period, which means your reporting date, probably, and reflect market expectation as at that date. That's why the standard says the discount rate that you have to use must meet certain conditions. 1, it must be pre-tax discount rate. And 2, it must reflect current market conditions and assessment. Do you get what I'm saying now? And 3, it should never reflect the risk associated with the variability in your estimated future cash flows. Because in determining your future cash flow, you have looked at scenarios that give you the likelihood of the appropriate future cash flow, or because probability will also take care of that. Therefore, your discount factor should never take care of issue of variability in attaining your future cash flows. And that is very key to us. You must take note of that. Now, what that means is that if I am to more or less readjust for my formula, I'll simply say my expected value will now be one plus what? R raised to power n, which means accounting for the effects of time value of money. Which means invariably, what I'm talking about is that it is P X2, X3, and so forth, and you discount it back. Okay, sorry. In this period, similar to how you do your discounting for cash flows. Period 1, period 2, period what? 3. Okay, now in that light, let's look at a typical example and let's try and estimate what the value is. Now we'll look at this example and we'll look for the following. A, the present value as at year 0, which is now. B, the present value at year 1, which is next 1 year into the future, and what represents the difference between the present value in year 1 and year 0. And how should the difference in C above be accounted for in the financial statement in year 1? Now, who can read the question from beginning to the end?
Okay, let me read it. For example, a company knows that when it sees a certain operation in 5 years' time, it will have to pay environmental cleanup cost of $5 million. The provision to be made now will be the present value of $5 million in 5 years' time. The relevant discount rate in this case is 10%. Required, find the present value at year O, which is now, the present value at year 1. Okay. What represents the difference between the present value in year 1 and year 0? How much should the difference in C above be accounted for? How should the difference in C above be accounted for in the financial statements in year 1?
Okay, who will guide us?
I think you have exposed us to a lot of things like this. From present value at year O, the present value of year O is the company know that it will say that's in 5 years' time it will have to pay cost. So basically, we discount this, the present value in year O. We have to what is this serious? It will pay less than 5 million for now. So we'll look for, we know the rate. This is 10%. The rate is 10%. Discount is 10%. And 5 years time, the future amount is 5 million. So we discount it to the present at this rate. I think that's what we do for the present value. We can use maybe IRA or the payment formula in Excel to do that. I don't know, but I think that's how it should be. That's for year one. For year O. Then present value at year one. You can also do that. At year one, what we need to do at year one, that's year O, this kind of present. Year one, we discount it by, I don't know of that one, no, Mr. Muyiwa. I don't know that, but I know that, yeah.
Now let's look at it. We'll go back to our model, as I said earlier. And what we need to do? Year zero is now. Now let's draw up our timeline. A company knows that when it sees a certain operation in 5 years' time, that means if I drop my timeline, year zero, year one, year two, year three, year four, and what? Year five. Is expected to pay in year five the sum of 5 million. And now we are saying, what is the value today? The value today is our ability to discount this back once, and don't stop there. Second time, it will stop there. Third time, it will stop there. The fourth time, and finally the what? The fifth time. Therefore, if that is the case, we say A. The face value of the obligation is 5 million. The discount factor from the information was 10%. Therefore, what is the present value? The present value of the most likely outcome. Remember, this is not like weighted average because it's a single item. Therefore, we are making use of the most likely outcome. Will be what? Will be for us to discount the $5 million by 1 plus R, which is 10%, raised to power minus 5. And therefore, doing that is saying the product of this and our discount factor, which is 1 plus 10% raised to power minus 5. Now, let me put 5 here. Number of years, which is a frequency. A frequency of discounting is 5 years. Now, in dollars, okay. That is that. Okay, very straightforward. This says what is the present value in year 1. If it's year 1, it means we are stopping here. And this is 5 million. It means we'll come back and discount it 1, 2, 3, and 4 times. Alternative to that is to move from year 0. You are going to year 5. But you first of all make a stop at year 1. And in year 0, we've gotten it to be 3.1. million from the information we had here. And what you do is to move from year 0 to what? Year 1. And you only move plus 1 time. And therefore, the 2 approaches we are going to use. Now, approach 1 is to use the same phrase here. The difference is that the frequency is now 4, not 5. And if it's 4 and not 5, okay, we didn't change it here. I link it. So far I've linked it. If I come here as a model, it will change automatically. And that gives me my figure for year 1, which means 4 times. And that is it. Alternatively, approach 2 is to compound, which means what I need is the present value in year 0. What is present value in year 0? What I have here. And my compounding factor is the same rate for discounting factor. It's the same rate, 10%. Now, the frequency in years is that I'm only doing for 1 year. I'm compounding for 1 year. Okay, and therefore, I'll compound. My present value now will be the 3.1 sorry, this 5, this 4 will be 3.1 104 million compounded by 1 year. And therefore, what is it? It's a product of this 3.1, 1 plus the compounding factor raised to power 1 year. And that's it, you get the same answer. Okay, and that is that. The third question is, what is the difference? The difference between this and this is how much? Is 310,000. That 310,000 is the finance cost. Or the unwound discounts. Which will be recognized in D in year 1 as an expense in your income statements. And this 310 alternatively can be obtained as the discount rate of 10% on the present value in year 0. What is that? 3104,067.28. No, sorry. 3104,606.62. Now let's find that 10%. The 10% of this is this. That's the alternative means of obtaining it, which you need to take note of. Okay. That is that. Now, how do we treat this? D. sum of 310, 460.66 will be treated as an expense in a finance charge. To profits or loss in year one, and a corresponding increase to liability. What type of liability? Provision in the balance sheet or your statement of changes, your statement of financial position. Does it make sense now?
Absolutely.
Okay. Okay. And let's copy that to our solution page. Okay. Any question before we proceed? Now we're going to look at other key factors. We're going to look at other key factors. What are the key factors? We're going to look at the effect of future events, the effect of expected disposal, the effect of reimbursement, and the effect of changes in equity. Changes in provision. What effect does it have in line with the requirements of IAS 37? Now, future events which are expected to reasonably occur must be taken into consideration when making provision. Okay, example might be whether there will be changes in technology, changes in government policy or legislation. This should be taken into account when estimating future values in which provision will be based. Also, when you expect to dispose of an asset, such a gain expected from such disposal should never be taken into consideration when making provision, which is provision should only be made from the perspective of the obligation that arose, not from whatever gain that can be derived in reducing the impact of that provision from the disposal of an asset. Thirdly, is that expenditure that you may incur in setting the provision may be probable to be recovered from a third party. The standard prevents us, as far as practicable, to recognize such an expenditure, which is a reimbursement cost, except if it is virtually certain that such reimbursement will be received if the entity settles such an obligation. And in that light, the reimbursement should be treated as a separate asset. Never will it be used to reduce the provision. And the amount recognized should not be greater than the provision you are making in the first place. Furthermore, the provision and the amount recognized for reimbursable may be netted off in profit or loss, but not in the balance sheet. Take note, remember, in the balance sheet, you show reimbursable cost, given that it's virtually certain to be recognized as a separate asset, and reimbursable provision, which is a provision for the liability, should be recognized separately as a liability. Now, the effect of changes in provision will be accounted for based on IFRIC 1, and we're going to discuss that, because IFRIC 1 makes us to understand that there are three conditions that could bring about changes in provision. One of those conditions is variability in cash flow estimates that may make us revise our provision, changes in discount rates based on current market assessments, or the timing involved might be varied, whether extended in time or contrasted in time. And the third one is changes that arose from passage of time. And in that light, we recognize such changes. But how do we recognize such changes? Where does it impact? Those are the things we need to take into consideration. Okay, in that light, I want somebody to read these summaries from the perspective of the standard. Mr. Nuruddin, over to you.
Thank you very much for this opportunity. Future events. Future events which are reasonably expected to occur, e.g. new legislations, changes in technology, may affect the measurement of the provision and should be taken into account. Expected disposal of assets. Gains from the expected disposal of assets should not be taken into account in the measurement of a provision. IAS 38, paragraph 51. Reimbursements. Some or all the expenditure needed to settle a provision may be expected to be recovered from a third party. If so, the reimbursement should be recognized only when it is virtually certain that reimbursement will be received and the entity if the entity settles the obligation. The reimbursement should be treated as a separate asset, and the amount recognized should not be greater than the provision itself. So, the provision and the amount recognized for reimbursement may be netted off in profits or loss. IAS 38, paragraph 53. Changes and provisions. At the end of each reporting period, a provision should be adjusted to reflect the current best estimate of the expected expenditure. A provision should be derecognized if the expenditure required to settle the related obligation is no longer probable. IAS 38, paragraph 59. Okay. Changes and provision. At the end of each reporting period, a provision should be adjusted to reflect the current best estimate of the expected expenditure. A provision should be derecognized if the expenditure required to settle the related obligation is no longer probable. IAS 38, paragraph 59. Specific types of provisions. It is easier to see the aims of IAS 38 if you look at example of what can and cannot be recognized as a provision under IAS 37. Some of these we have already touched on. These examples are the sort of situation you may get in the exams. And likewise in practice. A, warranties. These are argued to be the genuine provision as on past experience. It is probable, i.e., more likely than not, that some claims will emerge. The provision must be estimated, however, on the basis of the class as a whole and not on individual claims. There is a clear legal obligation in this case. Warranties are also covered by IFRS 15 revenue from contracts with customers. The nature of the warranty granted will determine whether the warranty should be accounted for under IAS 37 or IFRS 15. B. Major repairs. In the past, it was quite popular for companies to provide for expenditure on a major overhaul to be accrued gradually over the intervening years between overhauls. Under IAS 37, this is no longer possible, as IAS 37 would argue that this is mere intention to carry out repairs, not an obligation. The entity can always sell the asset in the meantime. The only solution is to treat major assets such as aircraft, ships, furnace, etc. as a series of smaller assets where each part is depreciated over shorter lives. Thus, any major overhaul may be argued to be replacement and therefore capital rather than revenue expenditure. C. Self-insurance. In the past, a number of companies created a provision for self-insurance based on the expected cost of making good fire damage instead of paying premium to an insurance company. Under IAS 37, this kind of provision is no longer justifiable as the entity has no obligation until a fire or accident occurs. No obligation exists until that time. D. Environmental contamination. If the company has an environmental policy such that other parties would expect the company to clean up any contamination or If the company has broken current environmental legislation, then a provision for environmental damage must be made. Decommissioning or abandonment costs. When an oil company initially purchases an oil field, it is put under a legislation. It is put under a legal obligation to decommission the site at the end of its life, prior to IAS 37. Most oil companies set up the provision gradually over the life of the field so that no one year would be unduly burdened with the costs. IAS 37, however, insists that a legal obligation exists on the initial expenditure on the field and therefore a liability exists immediately. This will appear to result in a large charge to profits or loss in the first year of operation of the field. However, the standard takes the view that the cost of purchasing the field in the first place is not only the cost of the field itself, but also the cost of putting it right again. Thus, all the cost of the decommissioning may be capitalized. Restructuring. This is considered in details below. Future operating losses. Provisions are not recognized for future operating losses. They do not meet the definition of a liability and the general recognition criteria set out in the standard IAS 37, paragraph 63. Onerous contracts. IAS 37 defines a onerous contract as a contract.
Onerous contract.
Okay. Onerous contract. IAS 37 defines an onerous contract as a contract in which the unavoidable costs of meeting the obligation under the contract exceed the economic benefits expected to be received under it. IAS 37, paragraph 68. For example, a supply contract related to a particular product that an entity can no longer sell will be onerous. IAS 37 requires a provision to be recognized for an onerous contract after recognizing any impairment losses for assets related to the contracts.
Thank you very much. Now let's pick them one by one again. Okay. Warranty. And warranty is one of the critical examples that we used in this session where we even did the expected valuation, expected value. Okay. And by virtue of the requirement of IFRIC 15 and IAS 37, warranty should be provided for once sales have been made, and such commitment is contained in the contractual arrangements between the entity and its customers arising from the contracts. 2, major repairs. As you have seen that because you are committed to major repairs does not mean you provide for it, because there's no obligation to do so. Why? 1, if the time comes, other circumstances might make you shift that commitment. 2, technology might have changed that such assets may no longer be required. Or 3, your business may no longer be supported by such an asset, and therefore the repair is no longer necessary. 4, the asset might actually be disposed of and be replaced with a new one. Therefore, there is no commitment, no obligation arising from such, and in that case, provision for overall major repairs should never take place. Okay, except if the entity has entered into a binding arrangement with a third party, and such becomes onerous. And when we get to onerous contract, we'll discuss that. Self-insurance. There's nothing like self-insurance for accounting purposes that will have warranted you to make provision. Because 1, Self-insurance in principle means instead of you to get insurance company to insure you, you are now insuring yourself by providing or setting money aside. Doing so does not qualify for provision because until the incident occurs and you incur a cost on it, you should not provide for it. Environmental contamination, you provide for it, one, if it is legal obligation, which means if the law, regulation, legislation requires it. For example, the issue we have with oil and gas company in exploration for oil and production, where there are environmental degradation through spillage and others. Legal obligation will make you provide. Constructive obligation can also make you provide even when there's no legal requirement, or because such damages may impact your relationship with the environment or with the immediate community. Therefore, you provide for it. Decommissioning and abandonment costs, we discussed this extensively under IAS 16. You make provision for it because you are by law or by constructive obligation meant to restore the site, the land, into its initial state. Okay, and the cost of doing so have to be projected into the future. And by way of provision, the most likely outcome is to recognize in full the discounted cash flow expected to be incurred in the future in order to restore such a field back to its normal state. And therefore, that will be provided for. Restructuring costs. Now, to provide for restructuring costs, there are certain conditions and exceptions. And I'm going to discuss that under a separate heading. Okay. Future operating losses. On no basis should you make provision for future operating losses because you are not bound by any commitment or contract to incur future losses. That's why you can discontinue a business, a product line, a division. Therefore, you should not. Lastly, onerous contracts. You make provision for onerous contracts. The question then is, what is an onerous contract? An onerous contract is a contract where the unavoidable cost of executing the contract or staying true to the terms of the contract outweighs its benefits, such that you cannot walk away. A typical example of onerous contract are throughput contracts, take or pay contracts, contract where you have made commitments and the other party has also committed resources such that you can no longer come in the future and say you are no longer interested. And in that case, you have to pay damages. Such a contract is deemed to be onerous. And in that situation, you make provision to the extent of damages or additional losses you will be bound to incur as a result of defaulting on such a contract. I remember, we also talked about executive contract at the start of the lecture. That executive contract is outside the scope of IAS 37 for provisioning, except if it is onerous. Can you remember? Except if it is what? Onerous. Now, let's quickly look at executive contracts. What are executive contracts? Because somebody asked me the other time. From the law dictionary or glossary, it says an executive contract, if I could enlarge it, let me try and enlarge it. Executive contract a contract under which underperformed obligation remain on both sides, or where both sides have continuing obligation to perform. For example, most leases or contracts for sale of goods where the goods have not been delivered by the seller and the buyer has not paid are executive contracts. A contract is not executory if goods have been delivered but the buyer has yet to pay. Executive contracts are given special treatment under bankruptcy code. The debtor has a choice to continue or reject the agreement. Now, what we are just trying to say is that executive contract, for sure, is a contract that can be repudiated or that can be nullified at the instance of either party because no commitment or consideration has been furnished by either party. And that is what we mean by executory contract. And that's why IAS 37 does not take that into consideration. Does that make sense to us? Okay, now let's move on. Now let's look at practical example of demonstrating understanding on onerous contracts. Who can read this question?
Example. Buster Co. has a contract which it believes to be onerous. The contract is for the future purchase of 2,000 liters of a chemical which is to be used in the production of laundry detergent. Buster Co. has sold its laundry detergent business but has been unable to assign the contract. The contract price is $150 per liter. At 30th September 2021, the spot price is $90 per liter. If Buster Co. cancels the contract, a cancellation fee of $135,000 is payable. Required. How should the contract be accounted for in the financial statement of Buster Co. at 30th September 2021?
What made this contract? What made this contract onerous? Who can tell me? What made this contract onerous? What make it onerous? And now are you
Price, yeah, the price of it has already the cancellation fee of 135 that is payable, and also the spot price has decreased to $90 per liter. So even if you want to sell sell the liter of oil, you cannot sell it. The chemicals, you cannot sell it below that spot rate, which is the current price, which actually has already paid about $150 for. I think I'm looking at that. So it is onerous because Buster has sold the laundry detergent business, but has not been to assign it. So it has, because it cannot execute the contract again, and it has actually incurred costs which it cannot recover. So I think that is what is onerous about it.
Okay, I think you didn't read the question. The question does not talk about what you have incurred. Let me explain the question. The question says, I am Buster. You are the supplier at your end. And me as a Buster, I've entered a contract with you. And that contract is binding. And the contract is like a forward commitment where it is binding that you will provide me 2,000 liters of certain chemical, which you have to produce within your own laboratory. Okay? And I've committed to it. That's why you have started to incur costs and doing also of what you're doing to deliver it. Now, as time goes on, I discovered that the business line to which I needed that chemical as a raw material is no longer profitable, no longer viable, no longer sustainable. Therefore, I discontinued that business line. Which then means that I no longer need that chemical. But the problem is I must take that chemical and pay because somebody else has committed to it to produce that chemical. And the contract is binding on me to take it 2,000 liters at an agreed price, which is a forward price. If you remember our discussion on forward price of 150 naira per liter. Now, what can I do? I'm in the midst of two evils. I go for the lesser evil. What is the lesser evil? Is that there's nothing I can do. I must buy and take delivery of that 2,000 liters. Now, if I take delivery of that 2,000 liters, what then should be at my back mind? The back of my mind is that I should be looking for who I can sell it to in order to salvage my situation. Unfortunately, the current prices of that chemical in the market is now going for $90, which means if I buy it at 150, I can only sell it at 90. The question then is, what is my likely loss that I need to provide for? Why am I providing for the loss? Because it is onerous on me that I must incur that loss in fulfilling the contract and agreement, which is the sanctity of the contract with the supplier. Now, the question then is, if I don't take it, I must pay that supplier a cancellation fee of $135,000 and I walk away. Or I must take that 2,000 liters at 150. The question then is, can I make provision? That's the first question. Two, if I can make provision, what will be the maximum amount of money I will provide for? Is it 135,000 naira payable as cancellation fee? Is it 150 times 3,000 liters, which is 300,000 naira, that I must use to buy that chemical? Or what? That is the question. Who can provide a solution? Who can provide a solution? Put yourself in the shoe that it is you are the CFO of that entity. What will be your position?
I'd rather take it and sell it for $90 per liter. I think that one is
okay. What
that's
obligation that you need to provide for, since it is onerous?
I'll provide for $120, $120,000.
Okay. Let's look at it one by one. Option available to me are one, cancel and pay damages of how much? 135.
Can see your screen.
Okay. The option available to me is to cancel and pay damages of $135,000, or take delivery of 2,000 liters at how much? At $150 per liter, which is in the sum of how much? $300,000, and do nothing with the chemical or throw it towards away. Throw it away means, what does throw it away means? It's like it's useless to you and you try and dispose it off. In safe harbor, so that it doesn't become environmental hazard, which means you lose the entire 300,000 because you must pay. And when the person gives me, I just try to throw it away. Or as a reasonable entrepreneur, I take that delivery of 2,000 liters at 150 per liter, which is in the sum of 300,000. But rather than throw it away or do nothing with it, I seek a buyer in a market overt, that is in an open market, where I can resell it for how much? For $90, I mean, per what? Liter. $90 per liter means how much? 90 times 2,000, which is in the sum of 180, I mean, $180,000. Hence, the maximum potential loss, which is onerous to the entity, is how much? 120. How do you get 120? Difference between 300K and what? 180K. Now, you as a reasonable person, a rational CFO, which option will you advise your management to take? Is it the one that will bring about loss of 135? Is it the one that will bring about loss of 300,000, or the one that will bring about loss of 120,000?
120,000, of course.
Therefore,
120,000.
what would be our conclusion? Our conclusion in that case would be as follows. Can somebody pick it up? What is the solution now?
Okay, Bosca can either cancel the contract at the cost of $135,000 or fulfill the contract and sell the chemical at the spot price.
Which means in our own case here, this 135 is no. I mean,
yes.
Is no. But what is yes? 120.
Or fulfill the contract, yes, okay.
Read it, continue. Continue, sir.
Okay, or fulfill the contract and sell the chemical at the spot price, resulting in a loss of $113,000. And yeah, I think those are the two options.
Okay. Now let me find another question. Another interesting question. Okay, who will read this question for us?
For the example, LIFCO enters into a contract with a customer to construct an asset on the customer's premises for a fixed contract price of $100,000. The total estimated cost of fulfilling this contract are $120,000. LIFCO is prepared to enter into this contract to establish a relationship with the customer with the aim of winning future business. The contracts contain a clause that if LIFCO withdraws from the contract, it must pay the customer compensation of $30,000 required. Calculate the amount of the provision in relation to these contracts.
Now, who can narrate what has happened so that can give us guidance towards solving the problem? Who can narrate what has happened?
So what happened is that LIFCO being the contractor here, and the contract price is you want to fix construct something for a particular customer, the customer's premises, but the contract price is $100,000, and the cost of fulfilling the contract, which is about $120,000, that is $20,000 above the contract price, so it's a loss-making contract. But LIFCO is prepared to enter into the contract in order to, despite the loss, just in order to win future contracts from that same customer. But he also has the option of actually, there's a clause in the contract that says that if he withdraws, LIFCO must pay $30,000 to the customer. I haven't signed that contract. So I think that is what is there. So from that, I would just say that it's better if you fulfill the contract and make a loss of $20,000 and win future businesses, if possible. That is more reasonable than $30,000 to pay back.
Anyone with contrary answer? Okay, now let's see the position adopted. Can you look at the position?
This is one errors contract as well, right?
Yes.
Yes, thank you.
Can you read out the solution?
Solution. A provision should be created for the lower of 1, the net cost to fulfill the contract, $20,000, i.e. $100,000 revenue less $120,000 costs. 2, compensation or penalty from withdrawing from the contract, $30,000. A provision for $20,000 should be created.
Thank you very much.
Okay, sorry. Can I just answer? Onerous contract, basically, in a nutshell, is a contract that you are likely going to make a loss on. Either ways, you will make a loss. So you make a provision for such.
Yeah, that's why yes, and it's compulsory you must make it because you can't run away from it. Because naturally, when you know that you have a loss somewhere, what do? You avoid it. But this one is unavoidable because you have committed to it that no, I will stay with it. And if I don't stay with it, you will incur further losses by way of compensation or penalty or damages. Does that make sense? Now let's look at restructuring. Now, companies are committed to restructuring, which might take a form of deleting a product, deleting a division, changing management structure, reorganization, like scheme of external restructuring, merger, acquisition, and etc. The question then is, when management is committed to a restructuring activity, associated costs, the word associated future costs to that restructuring, can we provide for it? Does it meet the criteria for recognition of provision under IAS 37? Now, this is a dilemma. The dilemma is that in certain instances, you can provide for restructuring costs. In other instances, you may not be able to provide. But the question is, what condition must be fulfilled for you to provide that? The standard makes us understand that there are two conditions that, if they are met, restructuring costs must be provided for. But if at least one is not met, restructuring costs will not be provided for. That is a dichotomy there. But the question we need to ask ourselves is, what is restructuring cost? Restructuring costs are costs associated with restructuring by an entity in whatever form it is. The next question then is, what constitutes restructuring to an entity? The standards in paragraph 10 define restructuring as a program that is well planned and controlled by the management of the entity. And furthermore, that such activity materially will change either the scope of the business being undertaken or the manner to which the business will be conducted in the immediate future. Once you have either of this activity, we say restructuring is taking place. Now, every cost associated with restructuring or incidental to restructuring is what we call restructuring costs. But the question then is, are all restructuring costs going to be provided for since they are future costs? If you go back to our discussion earlier, we said you don't provide for future operating losses, but can we provide for future costs? The question is, if you want to provide for future costs, certain conditions must be in existence, especially as it relates to restructuring. Now, the first condition is that restructuring costs will only be provided for if the management has demonstrated by way of detailed plan that they are committed to such a restructuring, which means it's not by way of consideration. Rather, it is like the whole process of that restructuring has been agreed upon and has been formalized. That is the first condition. The second condition is this: mere formalizing, documenting, agreeing, and you're not going back is not sufficient for you to make provision until you formally communicate the effect of such restructuring to parties that may be affected by such restructuring. The parties may include employees, other stakeholders like customer, vendors, and some other things. And in that regard, you have created a valid expectation in the minds of those that are likely going to be affected by that restructuring. It's until you do that that you cannot proceed to making a provision. Which then means that the two conditions you must meet in order to provide for restructuring costs are: one, there must be establishment of a detailed formal plan by the management, and two, these have been communicated with its likely effect to those parties or stakeholders that are likely going to be affected. The communication does not mean you will tell the employee that, you, Mr. A, you will be sacked. You, Mr. B, you will be retired. No. But employees in general have been communicated to that the management is considering this. Management have put up plan in order to take the company to the next level. And as a result of that, certain number of employees will have to be more or less told to go, and compensation will be paid, and all sorts of things. That is enough communication that has created a valid expectation in the minds of those that are likely going to be affected. And until this is done, restructuring costs will not be provided for. Okay, now IAS 37 paragraph 70 gives examples of events that may fall under restructuring. One of them is when you sell or terminate a line of business, when you close business location in countries, in region, or you locate business activity from one country to another or one region to another. When you change management structure, okay, and when you do fundamental reorganization that have material effect on the nature and focus of the entity. A typical example of this is what GTB just done with respect to reorganization by creating GT Co as the holding company and as the GT Bank and some other things as the subsidiary. Okay, and that is that. Any question on this?
So, our provision will only happen if the event, if at the end of the current period, we are aware of certain information. Because why I'm saying this, because in there will be no need to make a provision if a particular event will happen the same. For instance, like this onerous contract we're talking about, if that onerous contract will be executed within a period of 1 year, there's no need to make a provision. At the end of the year, you will have actually.
Don't make a mistake. Onerous contract is not what we're talking about.
No, I'm just coming to this.
Onerous contract, once you know something is onerous, it's immediately due for provisioning because you are bound by that contract, the sanctity of that contract. Do you get what I'm saying now? Restructuring, you are not bound by it because it's your discretion as management to restructure or not to restructure.
Okay.
Yeah. Now, on that basis, I want you to read this to provide more clarifications to you.
A mere management decision is not normally sufficient. Management decision may sometimes trigger recognition, but only if earlier events such as negotiation with employee representatives and other interested parties have been concluded subject only to management approval. When the restructuring involves the sale of an operation, then IAS 37 states that no obligation arises until the entity has entered into a binding sale agreement. This is because until this has occurred, the entity will be able to, this is because until this has occurred, the entity will be able to change its mind and withdraw from the sale, even if its intentions have been announced publicly. Costs to be included within a restructuring provision. A restructuring provision should include only direct expenditures arising from the restructuring. Direct expenditures are those which it has been necessary to incur because of the restructuring and which are not related to the ongoing activities of the business. Costs relating to marketing and new systems like the distribution network, as well as costs relating to retraining or relocating existing staff should not be included in a restructuring provision. IAS 37, paragraph 51.
Okay, let's now look at practical examples that will tell us whether we need to make provision or not to make provision relating to expected restructuring and other forms of potential events or event that will create provision. Now let's look it one by one, and I want you to answer them. In which of the following circumstances might a provision be recognized? Let's look at the first one. On 13th of December 2019, the board of an entity decide to close down a division. Decide means that there's no going back. Decide is different from considering. Okay, which means in that case, it has met the former detailed plan. The accounting date of the company, that is the reporting date, is 31st December. Before 31st December 2019, the decision was not communicated to any of those affected, and no other steps were taken to implement the decision. Therefore, does this qualify for provision? Does it qualify for provision?
It does not. It does not.
Why?
Because the decision was not communicated to any of those affected, and no other steps were taken to implement the decision. So
only one condition was met, but two conditions compulsorily must be met. Therefore, no provision. Now let's look at the second one. The board agreed a detailed closure plan on 20th of December 2019, and details were given to customers and employees. Should we make provision as a 2019 financial statement?
Yes.
yes,
Right.
Because it was agreed and it was communicated to the appropriate parties.
Okay. The next one. A company is obliged to incur clean up costs for environmental damages that has already been caused. Should we provide for it, and why?
yes, you should provide for it because
Yes.
a company is obliged to. There's an obligation, a constructive obligation.
Okay.
It suggests a constructive.
In this case means there's obligation, even though we don't know whether it's legal or constructive, but there is obligation from the term obliged. Finally, a company intends to carry out future expenditure to operate in a particular way in the future.
No. This one,
No
there's
provision for this.
Why?
Because it is
no
an
intention.
intention. It may not even come up in the nearest future.
And it's not compulsory they do it, and nobody will be hurt if they decide not to do it.
Exactly.
It doesn't even qualify for restructure because we are not even giving information about it to change the former plan of business or the direction. Therefore, it is not. Okay, let's look at the proposed solution. Can somebody read the solution? Read the question, read the solution. Read the question, read the solution. And let's see whether we're right.
A. On 13 December 20X9, the board of an entity decided.
Start with the question. In which, let's rephrase.
Okay. In which of the following circumstances might a provision be recognized? A. On 31st December 2023, the board of an entity decided to close down a division. The accounting date of the company is 31st December. Before 31st December 2009, the decision was not communicated to any of those affected and no other steps were taken to implement the decision. Solution. No provision would be recognized as the decision has not been communicated. B. The board agreed a detailed closure plan on 20th December 2009 and details were given to customers and employees. Solution. A provision would be made in the 20X9 financial statements. C. A company is obliged to incur cleanup costs for environmental damage that has already been caused. Solution. A provision for such cost is appropriate. D. A company intends to carry out future expenditure to operate in a particular way in the future. Solution. No present obligation exists, and under IAS 37, no provision will be appropriate. This is because the entity could avoid the future expenditure by its future actions, maybe by changing its method of operation.
Okay, thank you very much. Now, I believe this is clear.
Very clear.
Yes.
Okay. Any other question before we proceed? Any other question before we proceed? Okay. Now, we'll move to contingencies and later come back to IFRIC 1 about changes we observe with respect to provisioning, especially for the decommissioning, restoration, and abandonment costs. Okay. Now, contingencies could either be assets, could either be liability. But I'll put this question to us. Is contingent liability a liability? And justify any of your position. And likewise, is contingent assets an asset? Justify your position. Mrs. Tomilayo, are you there?
Yes, I'm here. I'm listening to you, sir.
Okay. Okay, I think your baby is there. Will disturb us. Okay. Enaro, you want to say something?
Yes, I was saying that contingent liabilities based on the standard is a liability, and because so I will look at it this perspective that, you know, in accounting there is this prudency concept that we must be very prudent in recognizing liabilities and revenue and expenses. Very, very prudent. So in that light, contingent liabilities will be recognized on the prudential principle, and contingent assets may not be recognized immediately based also on that principle.
Okay, who else? Who else? Now, let me put it to us. Contingent liability is not a liability. At least today, we also further demonstrated what constitutes liability, whether payable, accrual, by way of accrued expenses, and provision. But contingent liability is not a liability, but it has a thin line with a liability. And liability that it has a thin line, or the component of liability has a thin line with, is provision. But what is the difference between a contingent liability and provision? Who can tell me? The thin line between contingent liability and provision, just thin line, very thin. Sometimes people misconstrue it. Who can say something about it?
Probable and possible. Probable and possible.
Using descriptive words. Yeah, it's descriptive. Now, let me give you a clue. The thin line between provision as a liability and contingent liability as not a liability is that provision is uncertain. Likewise, contingent liability is uncertain. But to what degree? Provision is uncertain in timing or amount. Listen to me. Provision is uncertain in timing or amount, which means it's one of the two that is uncertain. If timing is uncertain, amount is certain. If timing is certain, amount is what? Uncertain. That is why it's provision. But contingent liability is uncertain in both timing and amount. That is why it's a possible obligation. Whereas provision is a present obligation. But again, why I say you should not use the word possible and present obligation is that even we have to the extent where contingent liability might be a present obligation. And we're going to see that. Therefore, the best way to distinguish between a contingent liability and provision is that provision is uncertain with respect to timing or amount, while contingent liability is uncertain to timing and amount. Now, let's look at it in real sense. A contingent liability could be defined from two perspectives. One, being a possible obligation. Second consideration is when is a present obligation. Now, if it's a possible obligation, the fact is that it arose from past events, but whose existence arose from past events, but whose existence will be confirmed only by the occurrence or non-occurrence of one or more uncertain future what? Event, not only within the control of the entity, which means a contingent liability is a conditional liability, which to a higher degree is uncertain with respect to timing and amount. Furthermore, it can take another shape where it looks like a liability to higher level of degree because it's a present obligation that arose from past events. But take note of this, it's not recognized as a liability, but rather as a contingent liability because of one or two of these situations. One, it is not probable that there will be transfer of economic resources in order to settle it. I remember, if you go back to the definition of liability, one of the conditions to recognizing liability is that it must be probable that it will result in an outflow of economic resources. But here, it is not probable. It's not probable because the degree of probability is less than what? 50% Remember. Or it may be probable it will result in outflow of economic benefits, but the amount cannot be measured with any sense or degree of reliability. Which that means that in such a case, in all respects, such will be characterized as a contingent what? Liability. But the question is, what is the essence of this struggle about distinguishing a liability or provision from contingent liability? Is because a provision will be recognized in the books. The monetary value will be shown in our balance sheets, and the impact will affect our profit or loss. But a contingent liability will not be accounted for. Neither will it be more or less shown in our balance sheet, nor will it have effect on our financial performance. But rather, what we only ensure we do to it is that we disclose it in our financial statement via what? Notes to the account. Does that make sense to us? Does that make sense to us?
Yes.
Okay, now let's look at practical example as given by the standard. Contingent liability should never be recognized in the financial statements. Never be recognized financial statement does not mean it won't be shown in the financial statement. But will not be recognized means in monetary terms, it will have no effect on our financial position nor on our financial performance. But will still be shown in our financial statement by way of what? Disclosure, by mere providing information to the stakeholders about the contingent liability. And in that regard, you will be required to disclose the following: brief description of the nature of the contingent liability, the estimate of any financial effect, if likely, that is, if you can reliably estimate it, any indication of the degree of the uncertainties that surrounds it, and any possibility of any reimbursement peradventure it crystallizes. And until contingent liability crystallize, that is, these conditions here no longer holds, therefore it becomes a full-fledged liability that cannot be provided for and recognized in the financial statements. And remember, recognition principle is about bringing in an element of financial statements into the accounts by recognizing the monetary effect of it in our balance sheet and income statements. Does that make sense? Does that make sense?
Yes.
Yes.
Okay. Now
I want to confirm something, please.
Yes.
Okay, so we are saying that contingent liability should only be recognized in the financial statements when we are sure that it will occur. You know, contingent means that it's on the basis that it will occur. There are instances that it will occur maybe in the future.
Okay, don't make mistake. We didn't say we should recognize it. Once
Okay.
it's still contingent liability, we are not going to recognize. We only disclose. But I said situations.
So what if it now occurs in the future?
That's what I'm saying. When it crystallizes, means it's no longer a contingent liability. It has now metamorphosed into liability by way of provision.
Okay, sir.
Which means it's no longer contingent liability. Provided it's still contingent liability, under no condition will you recognize it. But once it has changed its status and has become a full-fledged liability because it's now probable to be settled in cash and it can be measured reliably, in that instance, it is no longer contingent liability, but a full-fledged liability and must be provided for. Does that make sense?
Yes, sir, it's clear, sir.
Okay, contingent asset is the opposite. As contingent liability is a possible liability or obligation, contingent asset is a possible asset that arose from past event and whose existence will only be confirmed by the occurrence or non-occurrence of one or more uncertain future events, not only within the control of the entity. What makes it contingent is because it is conditional upon things you have no control over. And those things you are even talking about have a higher degree of uncertainty. And therefore, a contingent asset, like a contingent liability, will never be recognized because it is not an asset. Now, it is only when it is reasonably certain that economic benefit will flow from it that it converts to be a full-fledged asset, which you can recognize. And at that point, it is considered that it's no longer a contingent asset, but an asset. And again, contingent asset is not disclosed. It's not recognized, neither is it disclosed, except if it is likely on the basis of materiality and other factors that providing such information will be useful to financial users of financial reports, and on the basis that, as you consider it, its occurrence of being crystallizing as a full-fledged asset is not remote. That is, it is skewed towards meeting up an asset at a later date than not meeting the condition of an asset. But in most cases, contingent assets are not disclosed in order to avoid creating unnecessary expectation of additional value that may not come into the organization by way of economic benefits. Let's take note of that. Any other question on that? Now let me give us exercise, or let me give us an example. Now let's look at examples of contingent assets. Can somebody read this up for us?
Example of contingent assets. A company is engaged in a legal dispute. The outcome is not yet known. A number of possibilities arise. One, it expects to have to pay about $100,000. A provision is recognized. Two, possible damages are $100,000, but it is not expected to have to pay them. A contingent liability is disclosed. The company expects to have to pay damages, but is unable to estimate the amount. A contingent liability is disclosed. The company expects to receive damages of $100,000, and this is virtually certain. An asset is recognized. The company expects to probably receive damages of $100,000. A contingent asset is disclosed. The company thinks it may receive damages, but it is not probable. No disclosure.
Okay, now I believe that is clear. Okay, now let's look at a flowchart as given in the implementation guideline, part B of IAS 37. You could make reference to it, but let's look at the flowchart. And let's try to follow this flowchart. At every point in time, it will provide you basis of disclosure. Now, let's look at this. At the start points, you ask yourself a question. Is present obligation as a result of an obligatory event in existence? If there is no present obligation, you move to ask this question. Because if there's no present obligation, there might be possible obligation. But if there's a present obligation, you move downward to ask the question that is it probable that it will result in an outflow of economic benefits? If you say no, you come to this level. But we'll come back to the no. But if it is probable, therefore, you say yes. I will now ask ourselves another question. Is it reliable that we can estimate the amount of that obligation? If it is yes, therefore you make provision. You make what? Provision. Or because he has satisfied all the three conditions associated with a liability. But let's go back to this first question. Because there's no present obligation, we ask ourselves, if there's no present obligation, is there a possible obligation? If you say no, automatically we don't account for it or do not recognize in the financial statement. That's what it means. Two, it might be a possible obligation, but unfortunately it is remote. Or it might be a present obligation, but unfortunately the probability or degree of having to result in an outflow of economic benefit is remote. In that case, if it's remote, it means it's more likely that it will never happen. Therefore, we do nothing because it is a contingent asset or contingent liability as the case may be. And in that case, we only disclose. Okay? What you do is what? You disclose based on the conditions that we have discussed earlier. Now, but if it's not remote, which means it might likely occur to some degree. Therefore, what do? You recognize as a contingent what? Liability. Here also, if your answer is no, you also disclose a contingent liability. But this side is more of affecting contingent assets, because most times, as I've said it, contingent assets will not even be disclosed, except if it is not going to be removed in that case. And that's why I put this issue of disclosure. But at all points in time, contingent liability is much more going to be recognized rather than not being recognized. Will much more be disclosed, rather than not being disclosed, but not recognition. Provision will only be recognized, while contingent asset and contingent liability will never, for any reason, be recognized until they change status to become a full-fledged asset when it is virtually certain, or a full-fledged liability when the three conditions have been met to depict it as a liability. Any question?
Sorry, I want us to review the last question in the examples. I think the answer to that question is no disclose. I have little issue. Please, can we go back to that example?
Okay. Yeah.
Okay. The company thinks it may receive damages.
What think?
Assume.
I've been thinking. It's not even assume. Think. What is thinking? I've been thinking that I'll be a billionaire since all these days. But where I am. Yeah?
Okay.
Who does thinking help?
Okay, I get it now. I get it. I
If
actually
your
want
lawyer
to be sure
is
that
telling
it
that
is
I think you will get compensated, you should know that he's just trying to make your life so that you are just he's buying time. Okay, does that make it clear now?
Yes.
Okay, now let's look at this question. Can you answer this question? Can somebody read it aloud?
Question. During 20x0, Smart Co gives a guarantee of certain borrowings of Pony Co, whose financial condition at that time is sound. During 20x1, the financial condition of Pony Co deteriorates, and as at 30th June 20x1, Pony Co files for protection from its creditors. What accounting treatment is required at 31st December 20x0 and B at 31st December 20x1?
Okay. Who will attempt this? Or who will first of all narrate it?
So Smart Co guarantees or says that it will pay Ponyco's creditors if Ponyco fails to pay its obligations. So basically, at that time, the books, the account of Ponyco was sound based on. So what accounting treatment is required? I will assume that should be for Smart Co. There will be no accounting treatment required as a 20x0. But for 20x1, when Ponyco has declared bankruptcy, then Smart Co will have to make provision for the extent of the guarantee for of Ponyco. Ponyco, yes.
I think you are more than 100% correct. Now, let's look at what the position is needed.
Answer. A. At 31st December 20x0, there is a present obligation as a result of past obligating events. The obligating events in the given is the giving of the guarantee, which gives rise to a legal obligation. However, at 31st December 20x0, no transfer of resources is probable in settlement of the obligation. No.
And now, can you continue from there? I think his network is bad.
I'll take it all over again. So as at 31st December 20x0, there's a present obligation as a result of past obligating event. The obligating event is the giving of the guarantee, which gives rise to a legal obligation. However, as at 31st December 20x0, no transfer of resources is probable in settlement of obligation. No provision is recognized. The guarantee is disclosed as a contingent liability unless the probability of any transfer is regarded as remote. As at 31st December 20x1, as above, there is a present obligation as a result of past obligating events, namely the giving of the guarantee. As at 31st December 20x1, it is probable that the transfer of resources will be required to settle the obligation. A provision is therefore recognized for the best estimate of the obligation.
Okay, can we look at this question? An arrow. Warranty provides standard warranty at the time of sales of products to its customers. Under the term of the warranty guarantees the product will perform as expected for a 3-year period from the date of sale. Should provision be recognized on this form of warranty that warranty guarantees on its product to its customers? Should provision be recognized, and why?
This is a tricky one. I don't think a provision should be recognized because, number one, timing and the amount is not certain. None of them is certain there. You got it. So I don't think
let's
about
look at it. Why do you believe provision should not be recognized when is it today they have been making available such products where you have sufficient information about your historical return? If you remember, under IFRIC 15, we discussed it with respect to the issue of returns available as an option for customers for the purpose of default and some other things. Now, it is a practice that your pattern of past practices has shown that returns are made and repairs are done. And on that basis, provision will always be made for warranty costs. Okay, associated with replacement of defective products, with respect to repairs of defective product and etc. Therefore, warranty cost should be provided for as far as the company can reliably estimate using the expected value. And those are the things we discuss under provision. Let's look at what the position is. Can you read it out and see actually why it is onerous on you to ensure that you replace or repair without walking away? Over to you.
Okay, answer. Warranty cannot avoid the cost of repairing or replacing all products that do not perform as expected during the warranty period. A provision for the cost of this should therefore be made in respect of any goods sold before the end of the reporting period. Warranty is obliged to repair or replace items that fail within the entire warranty period. Therefore, in respect of this year's sales, the obligation provided for at the end of the reporting period should be the cost of making good items for which defects have been notified but not yet processed, plus an estimate of cost in respect of the other items sold for which there is sufficient evidence that manufacturing defects will manifest themselves during their remaining period of warranty cover.
Is it clear to you now?
Yes, using past historical record. Okay.
Okay. Moving you back, let's look at the last exercise. Over to you, Nuruddin. Can you look at the last exercise?
Okay. It's still the same warranty code. It has not changed. Okay, question. After a wedding in 20X0, 10 people died, possibly as a result of food poisoning from products sold by Caloco. Legal proceedings are started seeking damages from Caloco, but it disputes liability up to the date of approval of the financial statements for the year to 31st December 20X0. Caloco's lawyers advise that it is probable that it will not be found liable. However, when Caloco prepares the financial statement for the year to 31st December 20x2, its lawyer advised that owing to developments in the case, it is probable that it will be found liable. Required. What is the required accounting treatment? A, at 31st December 20x0, B, at 31st December 20x1. Okay, so my best of knowledge, for at 31st December 20x0, I think the entity will not make provision.
No, before you answer, before you answer it, try to narrate what has happened again. After reading it, narrate it.
Okay. The question
to guide us.
The question tried to explain that there are 10 people died as a result of food poisoning sold by Caloco. Caloco is the entity that sold the food at the wedding event, which resulted into death of 10 people. As a matter of fact, there is legal precedent in respect of the case, but as at 20x0, the lawyer for Caloco was given assurance that the Caloco will not be liable for any damages. As a result of that, in the book of Caloco, as at 31st December 20x0, Caloco is not expected to make provision for any liability. However, when there is additional proceedings in respect of the case, Caloco lawyer subpoenaed that there is probable that Caloco will be liable to pay damages as a result of the death of 10 people who suffered from food poisoning. And at 31st December 20x1, due to the available information, it is Caloco is now expected to make provision for liability in the financial statements, since there is information that it is probable that Caloco will be liable for that damage. You are moved.
Okay, thank you for what you've done. Yeah, let's confirm whether you are right. Let Enaru read the suggested solution, and let's see whether it's in tandem with the position you have provided to us.
Okay, as at 31st December 20x0, the answer 31st December 20x0, on the basis of the evidence available when the financial statements were approved, there is no provision is recognized. However, there is still a possible obligation, and therefore the matter should be disclosed as a contingent liability unless the probability of any transfer is regarded as remote. As at 31st December 20x1, on the basis of the evidence available, there is a present obligation. A transfer of resources in settlement is probable. A provision is recognized for the best estimates at the amount needed to settle the present obligation.
Okay. Thank you very much. Now, we are going to wrap it up with IFRIC 1, where there's a changes in existing decommissioning or restoration and similar liabilities. That's what we are going to wrap it up with. Everything about IAS 37 has been established, but there's an aspect of the interpretation guideline that affects IAS 37, and that's why we need to discuss that. Okay. Okay, we'll be discussing on IFRIC 1 that gives interpretation guidance to changes in existing decommissioning costs, provision, restoration, provision, and other similar liabilities, including abandonment costs. Okay, and what has happened is that there's a guidance to say that there are various factors that could bring about changes in this provision. And the standards make us to realize that there are three factors that contribute to changes in provision, especially the long-term provision. And these include one, a change in the estimated outflow of economic benefits, which means the change in cash flow. And this can come by way of the cash flow estimated being reassessed, or the timing where you assume that it will take 20 years to restore, which is after 20 years when you restore, but now your new revised estimate has shown that it's after 18 years or it's after 24 years, which means you either have an extended period or a contrasted period. That is one factor. The other factor is where there have been changes in the market-based discount factor or discount rates. And therefore, this could also bring about reassessment of the provision, given that the higher the discount rate or the lower it is will impact the provision measurement. Now, the third one is changes that can be attributed to passage of time, okay? And in that case, we say that deals much more with the unwinding of discount, which is what we have done earlier on by way of recognizing a finance charge or finance cost in our profit or loss by recognizing the present value differences between the last year and the current year. But what now happened is that this guideline is to tell us how do we treat changes in provision attributed to any of these three factors or combination of these factors. And that is what we wanted to look into. Now, to do that, I want someone to take up this and try to read the background from the perspective of the IFRIC Interpretation Committee. Over to you. Okay, let me take it up from here. Many entities have obligation to dismantle, remove, and restore items of property, plant, and equipment. In this interpretation, such obligations are referred to as decommissioning, restoration, and similar liabilities. Under IAS 16, the cost of an item of property, plant, and equipment include initial estimate of the cost of dismantling and removing the item and restoring the site on which it is located. The obligation for which an entity incurs either when the item is acquired or as a consequence of having used the item during a particular period for purpose other than to produce inventory during the period. IAS 37 contains requirements on how to measure decommissioning, restoration, and similar liabilities, which we have discussed earlier. And this interpretation provides guidance on how to account for the effect of changes in the measurement of existing provision for decommissioning, restoration, abandonment costs, and similar liabilities. Now, the scope of the standard is so clear. The standard, the interpretation applies to changes in measurement of existing decommission, restoration, or similar liability that is both recognized as part of cost of item of PPE in accordance with IAS 16 or part of cost of right of use of an asset in accordance with IFRIC 16 leases, and also recognized as a liability in accordance with IAS 37. For example, a decommissioning, restoration, or similar liability may exist for decommissioning of a plant, rehabilitating environmental damage in extractive industry, or removing equipment like removing an oil rig or platform after the life or cycle of that exploration has ended. Okay, the issue that has been brought to the notice as follows. The interpretation addresses how the effect of the following events that change the measurement of an existing decommission, restoration, or similar liability should be accounted for. There are three factors that will bring about changes. The first factor is that a change in the estimated outflow of resources embodying economic benefit, that is the cash flow required to settle the obligation. And in addition to cash flow, it might be an extended period or a contrasted period, which means you change the period to which you have estimated the cash flow, whether from 20 years to 25 years or from 20 years to 80 years. Secondly, a change in the current market-based discount rates in line with the requirement of IAS 37. Remember, our discussion earlier on says that the discount rate used must reflect the current market assessment as at the reporting date in which such provision is estimated. And finally, an increase that reflects the passage of time, which only can be attributed to the unwinding of discounts. Therefore, what has been the consensus that have been agreed by the members of the IFRS Interpretation Committee? Now, the committee first of all identified that, one, the accounting policy adopted by a company for its recognition of an item of PPE, first of all, might impact this consensus or decision to recognize the changes. Now, there are two policies available. The first one is a cost model. The second one is a revaluation model, if you go back to our discussion under IAS 16. Now, the way it will affect cost model differs from the way it will affect revaluation model. Now, I will explain. Now, let's look at the position clearly from the angle of the standard and the interpretation guidance. Now, if the related asset is measured using the cost model, which means cost model means you are using historical cost as a basis of recognizing the item of PPE. Okay, what will happen is that subject to B will come to B. Any change in that liability shall be added or deducted from the cost of the asset. What does that mean? If we have a change in the provision for decommissioning cost or restoration cost, and that change is attributed to either change in cash flow, change in timing of those cash flow, or change in discount rates that was used. Such increase in that liability, in that provision, or decrease in that provision will correspondingly be adjusted against the cost of that asset. What does that mean? It means that if provision was 10 million, and today it was reassessed to be 12 million, and that reassessment is attributed to the fact that discount rate has changed, or that the cash flow that was used to estimate it has changed, that 2 million difference will not be expensed. Rather, the 2 million difference will be capitalized along with the cost of that property, plant, and equipment. Conversely, if the provision was 10 million and it has now reduced to 8 million, and the reduction is attributed to the changes in the estimation as a result of cash flow or its timing, or as a result of changes in discount rate, the 2 million reduction will not be recognized as an income in the financial statement. No, it will be recognized as a reduction of the carrying amount of the property, plant, and equipment. Now, what is the subject to be that was stated here? That the amount deducted from the cost of an asset shall never exceed the carrying amount of the asset. What it means is that the 2 million you are deducting from the asset, in my second example, must not be more than the carrying amount of that asset, which means the 2 million will be deducted in full, provided the carrying amount of the asset is more than 2 million. If the carrying amount of the asset is 3 million, when you deduct 2 million, what is left is 1 million. And that 1 million will be the new carrying amount. But what if it is 1.8 million that is the carrying amount, but the reduction is 2 million? What you will do is that you cannot bring carrying amount of an asset to be negative, which means the first thing is that out of the 2 million, you knock off the entire 1.8 million, which means the carrying amount of the asset is 0. The remaining balance of that 2 million will now be recognized as income in profit or loss, which means like a decrease in provision. Conversely, also, a decrease in liability exceeds the carrying amount, therefore, that must be recognized immediately in profit or loss, which is what I've explained. Now, if the adjustment results in an addition to the cost of an asset, which means the 2 million of increase from 10 to 12 I explained earlier, the entity shall consider whether there's an indication that the new kind amount of the asset may not be fully recoverable. What it means is that the provision has been recognized so that it has increased from 10 million to 12 million, which means it has increased by 2 million. That 2 million will be added to the kind amount of an asset. Let's say the kind amount is 7 million. 2 million plus 7 million is 9 million. But that 9 million might not be probable to be recovered by way of economic benefits, which then means that probably the asset might have been impaired when you compare to the recoverable amount. Therefore, the standard says you should proceed to testing such an asset for impairment if it is likely that you can cover the entire 9 million. Otherwise, you write it down immediately with an impairment loss that will turn into the recoverable amount. But that is not the case when it comes to the revaluation model. Why? Because in the revaluation model, you will find out that there is a surplus already that might have been created by the valuation of that asset. Therefore, the changes that might have affected the cost of that asset by way of reduction or by way of increase should be routed to the revaluation surplus, except in a situation where such surplus does not exist. And let's look at what the position is. If the related asset is measured using revaluation model, what it means is that periodically we value the asset upward, and such gain arising from revaluation is suspended through other comprehensive income into a revaluation reserve as other component of equity. Therefore, what happens in that case? Changes in liability alter the valuation surplus or deficit previously recognized on that asset, such that, one, a decrease in liability shall be recognized in other comprehensive income and an increase in valuation surplus within that equity. Now, what does that mean? If the provision made before was 10 million, today the provision is 12 million. The increase in provision is 2 million, attributable to changes in cash flow, is timing or discount rate. That 2 million, rather than adjust it against the cost of the asset, such amounts will be adjusted against the revaluation. But before we go to that, let us assume first that there was a decrease in that provision from 10 million to 8 million. That 2 million that's supposed to be used to reduce the cost of the asset will not be used to reduce the cost of the asset. Rather, that 2 million will be recognized as a form of an adjustment or gain arising from remeasurement of a provision for decommissioning costs, which will be reported through other comprehensive income, similar to the way we report revaluation gains. And such, it will be used to increase the revaluation reserve in your equity. There's only exception to that. The exception to that is that it will not be transferred to revaluation reserve, provided before now, the revaluation deficit had been recognized previously in profit or loss, which means if the assets that is carried as value amount has already been impaired and the previous impairment has been reported through profit or loss, such a gain that should have passed through revaluation reserve will be recognized in profit or loss to the extent of the initial revaluation deficit or impairment loss that was already charged in previous period on that financial asset or item of PPE. Now, the other aspect is this. What if there's an increase in liability? What I just explained is a decrease in that provision. What if there's an increase in provision? That increase in provision means that provision of 10 million is now 12 million. The one I explained earlier was provision of 10 million becoming 8 million. But in this one now, provision of 10 million is becoming 12 million. The 2 million increase shall be recognized in profit or loss, straightforward, except that it shall be recognized in other comprehensive income and reduce your evaluation surplus within the equity to the extent that any credit balance existing in valuation surplus in respect of that equity of that asset. Now, what it simply means is that increase in valuation surplus, in decommissioning provision is going to bring about naturally an expense. Okay, which means increase in liability brings about debit in corresponding debits. And we are now saying that that corresponding debit should be recognized in profit or loss. Okay, but it will only be recognized in profit or loss if there's no evaluation surplus already. But if there's evaluation surplus, that's 2 million should be used to reduce that surplus up to the point that the surplus is more or less fully zeroized. And if the surplus is fully zeroized and there's still balance in that movement in provision, the excess will now be charged to profit or loss. Otherwise, if there is no evaluation surplus existing at all, the entire amount goes to profit or loss. Now, the following are other additional information. In the event that a decrease in liability exceeds the kind amount that will have been recognized at the asset being carried under the cost model, the excess shall be recognized immediately in profit or loss. This is synonymous to what I've explained earlier. Also, a change in liability is an indication that an asset may have been revalued in order to ensure that the kind amount does not differ materially from which will be determined using fair value at the end of the reporting period. Any such evaluation should be taken into account in determining the amount to be recognized in profit or loss or in other comprehensive income under A, as I've explained it earlier. If a revaluation is necessary, all assets of that class shall be revalued. Remember, it speaks to the requirement of IAS 16 that says once you revalue any item within a class, the entire class must also be revalued. The IAS 1, this with presentation of financial statement, requires disclosure in your statement of profit or loss and other comprehensive income, which is otherwise known as statement of comprehensive income. Each component of other comprehensive income or expense, and in complying with this requirement, the change in valuation surplus arising from the change in liability shall always be separately disclosed, which means even though they both impact revaluation reserve, what are they? 1, gain arising from revaluation. 2, changes arising from remeasurement of decommissioning provisions. Those two, though they affect evaluation reserve, but they must be disclosed separately and not offset within the presentation of other comprehensive income. Lastly, the adjusted depreciation amount of the asset is depreciated over the useful life, which means the remaining kind amount must be depreciated over the remaining useful life, similar to what we have discussed extensively under IAS 16. Therefore, only the related asset has reached the end of the useful life. All subsequent changes in liability will no longer affect asset again. Every other thing goes directly in profit or loss. And this applies for both cost model and evaluation model, because the asset to which the rule have been affected no longer exists because it has outused its useful life. Therefore, the liability only exists, and any changes in liability forthwith must impact profit or loss directly. The only exception to all of what I've discussed is the one that is attributed to issue that borders on increase that reflect passage of time, which is unwinding of discount, which is synonymous to the example we did earlier, which I'll show you once again. And in that situation, a periodic, usually a yearly unwinding of discount, shall be recognized as a finance cost or finance charge in your profit or loss as they occur. And this is not within the scope of IAS 23 borrowing costs that require capitalization. Rather, such will be expensed ultimately in your profit or loss. And if you go back to our discussion earlier enough, you remember this sub we did, this analysis we did here, where we asked ourselves a simple question: how should the difference in C above be accounted for in the financial statement? And what is the C above? The movement between the liability in 20, that is in year 0, and in year 1. This movement is attributed to passage of time. And what is that movement? This movement is attributed to what? Passage. The movement is attributed to passage of time. And therefore, that is why we said it should be recognized as a finance charge and treated as what? An expense in your profit or what? Or loss in year one. And that is what it is, which means out of the three things that bring about changes in provision, the only one that primarily, without giving cognizance to any of those guidance, goes directly to profit or what? Or loss. Okay, now in conclusion, we'll go back to our disclosure requirements for IAS 37. What are we to disclose with respect to provisions, and what are we to disclose with respect to other factors such as contingent assets and contingent what? Liabilities. Okay, can somebody read this up for me? What do you expect to disclose? Financial statements.
Disclosure.
Yes.
Disclosure IAS 37. For each class of provision, an entity shall disclose A, the carrying amount at the beginning and end of the period. B, additional provision made in the period, including increases to existing provisions. C, amount used, i.e., incurred and charged against the provision during the period. D, unused amount reversed during the period. E, the increase during the period in the discounted amount arising from the passage of time and the effect of any change in the discount rate. Comparative information is not required. Paragraph 85, an entity shall disclose the following for each class of provision. A brief description of the nature of the obligation and the expected timing of any resulting outflow of economic benefit. B, an indication of the uncertainties about the amount and timing of those outflows where necessary to provide adequate information. An entity shall disclose the major assumptions made concerning future events as addressed in paragraph 48. And C, the amount of any expected reimbursement, stating the amount of any asset that has been recognized for that expected reimbursement.
Okay, thank you very much. Any further question before we call it a day? Any general question? And as this met your expectations, and from the initial scenario you provided to us, what do you believe would have been the best thing to do with respect to liability that surface without having a prior knowledge of it?
Okay, I think based on this, what we studied today, that figure that came in, it is the figure is known, the amount is certain, and we're certain that it came from a past event. It's a liability basically, and I think the provision has to be made for it because the amount is certain and the timing is also certain to a reasonable extent. So, and
Which means the organization has established that is an obligation it owes, and the amount is not in dispute. If that is the case, you provide for it immediately. Otherwise, you consider the substance of the transaction before you take the next step. Okay, thank you very much. God bless you all.
Okay.